Good evening, folks. Hope you had a pleasant trading week and it wasn't harmful. Remember, we are in a stand down period of the year. I gave you guys two examples in here. It gave you a pseudo loss and a recovery, proving that even in low volatility conditions, our concepts do in fact still work, but it's a measure of how much of a risk to reward you're going to be undertaking. And for my personal tastes, this time of year doesn't bode well for me. Even though I'm able to do it, it's just too much work and concern while the trade is on. When more liquid times of the year, I don't really feel those effects while being in the positions. So without going all that, I gave you two rather lengthy videos this week to kind of like set the tone for this year and for the new members that came in, and then remind the old members and charter members you still have certain responsibilities as it relates to your end of our business partnership. I'm teaching, but you still have to practice. You have to log your experiences and take notes. I can't do that for you. And if I were to do what I'm showing you here, okay, this is exactly how my notes are on my personal journal. The only difference is I actually draw them just in a line format, and I write these notations, and that's it. And I make very, very crude depictions. I know what I'm looking at. To anyone else, even like a charter member, it won't be beneficial to them to see what my journal looks like. But if I were to have it in a digital format, which I don't, this is what it would look like. Okay, so I just look at specific key numbers and turning points relative to time. So it's time and price theory I'm tracking. And I have little notations as to where the current dealing ranges are and or wherever the next level of liquidity may reside. So we had a very consolidated week. We knew that going into it, we would have the likelihood of seeing this unfold. We had Tuesday's high of the week, true to form. We did have a rather tight dealing range across several days, but I outlined in video before the fact that we would have most likely a more meaningful move below this low. And 10 pip grades stop sweep is what we saw here. Then I mentioned again that it would most likely go down again and seek our 113.65, 113.55 levels respective to this low over here. The thing I want to talk about tonight is that I mentioned how these highs here, how I would have used those as a stop hunt for this particular trading day, the 17th. I would have used any rally above that during London to go short and then aim for the 13.75 as first profit, 13.65 as second partial, and then 13.55, 13.50 thereabouts to end the week and try to go on social media and brag about it. But the reason why I said that that wouldn't be likely is that we did not first run deeper into the liquidity like we saw it trade here. Now, when we traded down 10 pips below this low, what it does is sends IPTA, which is the interbank price delivery algorithm. That's the engine that delivers price. And if we have sell-side liquidity ran during a consolidation with a bearish tendency for the week or bias, once the sell-side delivery has been attacked in at least 10 pip grade sweep, we have that here. Go back and watch the videos and you'll hear me say that the reason why I wouldn't have expected this to be a sell-off day is because we would have to first see the run down. Then this level becomes hot. Okay, so this level becomes interesting. And what I'm going to do is I'm just going to have a horizontal line dropped on this chart. And it's going to get a little cumbersome because it's a lot of different notations on here. And you can see why quickly I don't have all this stuff on my chart as I'm teaching. Because I want you to look at the chart naked. And then you, as the developing trader, and you're developing an approach or a style that's unique to you, how you annotate your charts. I don't want you to do exactly what I do on my chart in terms of annotations. The points of reference are similar. They're going to be the same thing that you are going to be noting, but little quirky little comments, like obviously this is just for showmanship, just being funny because you guys are watching. But the point of logging and annotating your charts, you want to keep that personal. I get so many emails about that. Every time I mention journaling, invariably I get 15 to 20 people in the same week. They'll say, can you show me your journal? Or can you show me how to do a journal? I've done several instances of that, and we did a really good, in my opinion, presentation of it this week. So that's the one that I would more or less point people to, because it's rather quick. It's easy to understand. It's easy to see what I'm doing, and it doesn't take very long to do it. You don't want your journaling to be like a chore, because if it becomes a chore, you won't want to do it. So if you enjoy doing it and develop a knack for doing it and being organized about it, you're going to find that it's actually very rewarding, because on Saturdays or Sundays when it's no trading, you want to go back and look at every one of your entries for the day, each day, Monday through Friday, and you also want to get a feel for what it did for the whole week. Now, you're not limiting yourself, obviously, to a 15-minute chart. I've already showed that you want to have a spectrum of charts, like a 5-minute, 15-minute, 1-hour chart, 4-hour chart daily, and then at least at the beginning of the week, have your monthly and weekly chart annotated, what you think it may be trying to do. And that way, when you look at your charts at the end of the week on a Saturday or Sunday when the markets aren't trading, you'll have a greater perspective on what you were thinking because you wrote it down, and compare that to what the actual market did. And what will happen is there's a slow transition that will take place where you're going to start seeing that you see what the market's going to do before it actually does it. But you have to allow that time and growth to take place. And it's going to vary for all of you. Some of you are going to get it sooner than others, and it'll be faster for you to pick it up. Others, it's going to take a little bit more time, and it's normal. Do not be discouraged by that. And you can't speed it up. There's no secret to it. It's just everyone learns at a different pace. All right, so we have the 18th in here. The market runs up, hits those equal highs. Now, notice, again, I want to take you back to the condition that makes this a viable setup. We have to run the sell-side liquidity first, and it has to be at least a 10-pip sweep. We're in a consolidation market still, so once it hits the sell-side liquidity, IPTA will go into a seeking mode where it looks for buy-side liquidity. Obviously, once it hits it here, what does it do next? It goes immediately for the buy-side delivery here, right above these equal highs. We clean them, and then we come down one more time exactly to the same low. That candle's low is 1373, exactly the same low that's seen here, 1373. So now we have created what? A liquidity pool. Equal lows. I don't have it noted that way because I have the kill zone annotated. But we have equal lows, so what's building below that? As the market starts to press higher, what's it going to seek? Buy-side liquidity. That's these equal highs back here. So now we've created the condition for the market to want to seek buy-side during a consolidation. The market rallies up. We have equal highs in here as well. So we have a very small buy-side liquidity pool above here. Buy stops above here, and right in here, too clean. They're going to want to run that. During London, it's a shallow consolidation, and then going into New York, that's when we have our turning point again. We open up, look what the candle does here. It opens up above the equal highs, and then distribution. And then this candle here, we open and trade up to that same high, and then come right back down to the opening. One more time, we touch that level. The equal highs in here. Very, very sensitive. Price breaks down. Small little consolidation. And then heavy distribution. Where does it go? Everything we outlined this week. And unfortunately, I was wrong. And I mentioned this on Twitter. I gave you guys 113.55 as a downside objective. And we only got down to 13.56 for this feed. I also taught you this week best case scenario. That was like 113.50. So that way, if it was to really spike down into that with a great deal of momentum, there's nothing better than getting a grand slam. So if we get a single here at 13.75 as a partial, a double at 13.65, and a triple at 13.55, anything below that's a bonus, and it's like a grand slam. So little baseball analogy, but the overall context is this move here. Okay, you're going to learn about weekly profiles in the mentorship. There's a specific weekly profile for this. Okay, and the charter members and those individuals that have made it to that month, and to be honest with you, at the time of this recording, I don't recall what month it was. Please do not tweet it, because all it's going to do is draw up more interest for people outside the mentorship, and it's not meant for that. Okay, but you all know where that is in the content if you've gotten that far. If you haven't gotten that far yet, trust me, we talk about it. So this is a beautiful Friday reversal, and the actual swing takes place on the last trading day of the week, and very, very close to coming to fruition to our downside objective. But you can't really be upset about it, because we had the run to 13.75 to 13.65. That's a 20 pip grade sweep below Tuesday's low. So, I mean, you really can't be upset about that, because that would be enough in my book. If it gets down to this level here, then great. If it doesn't, you can't be upset, because that's a phenomenal type of sell-off. Beautiful, beautiful price delivery there. If we look at the bare bones of it, outside of mentorship level, because this is what this is here, it says mentorship level annotations and concepts. If we look at just a pure free tutorial perspective, this is what it would look like. Now, I'm only showing you this because I really want you to understand, even though this is very easy to see and it's clean, it doesn't have a whole lot of fluff in the chart, because I've already explained it to you with great detail in the other charts. But when I'm on public forum on Twitter and I share charts, you as an insider with the mentorship group, you can see things that I'm not annotating in the chart, but we have already mentioned in mentorship. There's things that I won't draw attention to, because I'm not trying to teach mentorship level on Twitter. And I don't even want to have it where I have enough of the examples on Twitter where someone can go back and point at it and say, oh, well, this is probably what he's been doing. I don't do that, and no one can reconstruct what I'm doing outside of this type of perspective here, which is really just the free level tutorial stuff. But you can see clearly there's a strong contrast between what has been taught in free tutorials and what is taught in mentorship. There are things that I'm not going to talk about in free lessons. It ain't going to happen. And since I don't do free lessons anymore, whatever's out there is what's out there. The increasing knowledge that comes by way of the concepts that I've yet to teach even charter members gets even more detailed than what we're talking about thus far. For a simple review in layman's terms, we had a very equal low here and here. So we have Candyland in the form of sell side liquidity. So we have a sell side liquidity pool here, and then we have relative equal highs in here for a buy side liquidity pool. Then next to it, we have an old high as well. Price rallies up from London into the New York open kill zone. Then we have the turning point. Then price does what? An aggressive repricing. Notice how fast price dropped down like that. Okay, price rally up, hit it, stopped dead in its tracks, heavy distribution. Boom. Went to where we outlined it before the fact. Just know that we have a couple more weeks still with January rolling into February. Yeah, we have next week and the week following. So it really won't be like the February 4th, that Monday, where I'll probably really start engaging. I'm hoping that we'll start to pick up with some nice liquidity runs on next week and the week following. But usually February, we've already smoothed out whatever holiday doldrums have been built into price. And we'll see a little bit more flurry in action. But that's it for now. I will give you guys a Monday weekly analysis video. Again, it will be muted because it's stand down time of the year for us. We don't try to push it too hard, but I will go into the cable and the euro dollar and the dollar index as I normally do. The quarterly analysis video, I was hoping that they would do something to get the shutdown resolved in the U.S. Since the shutdown is still going on, the Commitment of Traders report that is more or less managed by the CFTC, Commodity Futures Trading Commission, they aren't updating that right now because the government shut down. So I'm hoping that February 4th we'll have a resolution to the shutdown, and then they get back into the swing of things. So I'd like to see what the commercial holdings are. If they are not, if they haven't reestablished all the government agencies and such, and COT hasn't resumed on February 4th, I will still do a quarterly analysis. We just don't have that information because there's nothing we can do about it. They're not providing it. So it's not paramount that we have it because so much time is still left in the year, but it would just be better to have it, and we'll deal with it then.